Alfonso Cahero, A Journey into Finance History, Chapter 52, Dot-com Bubble, Late 1990s to 2000. In the early 1990s, the world was on the brink of an extraordinary transformation. The internet, once a mysterious realm reserved for academics and government officials, was starting to become accessible to ordinary people. At the heart of this revolution were visionary minds who saw an unprecedented opportunity: the World Wide Web. Tim Berners-Lee, a British scientist, invented the World Wide Web in 1989, forever changing the way people accessed information. By the mid-1990s, web browsers like Netscape Navigator made it possible for anyone with a computer to explore the digital universe. The internet was no longer a niche technology. It was becoming a mainstream phenomenon. Entrepreneurs and investors quickly realized the internet's potential. They envisioned a world where people could shop, communicate, and entertain themselves online. This vision sparked a frenzy of excitement, leading to the birth of numerous internet-based companies. These startups, often with little more than a promising idea and a catchy name, began to attract substantial investment. One such visionary was Jeff Bezos, who in 1994 founded Amazon.com. Bezos imagined a platform where people could buy books online, a concept that was both innovative and risky. But as internet use grew, so did Amazon's popularity. By 1997, Amazon went public, raising $54 million and cementing its place as a pioneer of the internet age. Amazon's success story was just the beginning. Entrepreneurs everywhere were inspired to launch their own dot-com ventures, hoping to replicate Bezos' success. Companies like eBay, founded by Pierre Omidyar in 1995, introduced new ways to conduct business online. eBay's online auction platform allowed users to buy and sell goods to one another, creating a digital marketplace that was both dynamic and lucrative. The mid-1990s also saw the rise of search engines like Yahoo and Google, which made navigating the vast expanse of the internet more manageable. These companies didn't just offer new services, they fundamentally changed how people interacted with the web. Venture capitalists, eager to capitalize on the internet boom, poured billions of dollars into dot-com startups. The Nasdaq Stock Exchange, known for its technology-focused listings, saw an unprecedented surge in internet company IPOs. The valuation of these companies skyrocketed, often based more on potential than actual profits. This speculative enthusiasm set the stage for what would become the dot-com bubble. Yet, amid this wave of innovation and investment, there were signs of trouble. Many startups, though rich in ideas, were poor in execution. They burned through investor cash at alarming rates, often without generating significant revenue. The market was flooded with companies that had little more than a website and a dream. Despite these warning signs, the public's appetite for internet stocks seemed insatiable. Stories of overnight millionaires fueled a gold rush mentality. Ordinary people, inspired by tales of instant wealth, began to invest heavily in the stock market. Financial advisors, media pundits, and even taxi drivers touted the limitless potential of the internet. This period, marked by a blend of boundless optimism and reckless speculation, was a time of both incredible opportunity and impending peril. The stage was set for one of the most dramatic financial booms and busts in history. As the 1990s drew to a close, the internet had transformed from a technological novelty into a cornerstone of modern life. The dot-com companies, symbols of innovation and possibility, had captured the world's imagination. However, the foundations of this new digital economy were not as solid as they appeared. Beneath the surface, a storm was brewing, one that would soon test the resilience of the internet dream. By the late 1990s, the dot-com boom was in full swing. The excitement around the internet reached fever pitch, and everyone wanted a piece of the action. The stock market became a playground for new and often unproven internet companies, leading to a dizzying rise in the value of dot-com stocks. Investors were eager to throw money at any company with a dot-com suffix, often with little regard for traditional metrics like profitability or revenue. It was a time when potential seemed to trump performance. This speculative frenzy was fueled by a sense of urgency. No one wanted to miss out on what seemed to be a once-in-a-lifetime opportunity. One of the iconic companies of this era was Pets.com, an online pet supply retailer. Launched in 1998, Pets.com quickly gained attention with its clever marketing campaign featuring a sock puppet mascot. The company promised to revolutionize the pet supply industry by offering convenience and competitive pricing. In February 2000, Pets.com went public, raising $82.5 million. Despite its initial success, the company struggled to turn a profit and became one of the most infamous casualties of the dot-com bust. Another high-profile example was Webvan, an online grocery delivery service founded in 1996. Webvan aimed to disrupt the grocery industry with its ambitious plan to build a network of high-tech warehouses and a fleet of delivery vehicles. The company raised hundreds of millions of dollars from investors and went public in 1999. However, Webvan's rapid expansion and massive infrastructure cost quickly outpaced its revenue. By 2001, the company had declared bankruptcy. Amidst the fervor, some companies managed to carve out sustainable business models. Amazon continued to grow, expanding its product offerings beyond books. eBay thrived as a leading online marketplace, proving that the internet could support successful businesses. These companies were the exceptions, however, in a sea of unprofitable ventures. The media played a significant role in fueling the dot-com frenzy. Financial news channels and magazines frequently featured stories of young entrepreneurs becoming millionaires overnight. This coverage fed the public's enthusiasm and drove more investment into the stock market. The Nasdaq Composite Index, heavily weighted with technology stocks, soared to unprecedented heights. Investment banks and venture capital firms were also caught up in the excitement. They aggressively pursued internet startups, eager to take them public and reap the rewards. Initial public offerings, IPOs, became a common occurrence, and the process often seemed rushed. Companies with little more than a business plan and a website were valued in the billions. However, the rapid rise of dot-com stocks was built on a fragile foundation. Many of these companies had no clear path to profitability and relied on continuous investment to stay afloat. They spent lavishly on advertising, office space, and talent, hoping to grow quickly and dominate their respective markets. By early 2000, there were signs that the market's exuberance was unsustainable. Some analysts began to voice concerns about the overvaluation of dot-com stocks. They pointed out that many companies were burning through cash at an alarming rate and showed little sign of becoming profitable. Despite these warnings, the public's enthusiasm for internet stocks remained strong. The belief that the internet represented an entirely new economy, immune to traditional financial principles, was widespread. This sense of invincibility blinded many to the risks. As the dot-com boom reached its peak, it seemed like the good times would never end. The promise of the internet was intoxicating, and the wealth it generated was unprecedented. Yet, beneath the surface, the cracks were starting to show. The bubble, inflated by speculation and unchecked optimism, was about to burst, bringing with it a wave of financial ruin and shattered dreams. In the year 2000, the dot-com boom reached its zenith. The atmosphere was electric, filled with an almost palpable sense of excitement and possibility. The stock market was on fire, with technology stocks leading the charge. For many, it felt like a new era had dawned, one where traditional economic rules no longer applied. On Wall Street, the Nasdaq Composite Index, heavily laden with technology stocks, climbed to all-time highs. Investors from all walks of life were eager to jump on the bandwagon. Stories of individuals striking it rich by investing in dot-com stocks were ubiquitous. It seemed as though anyone with a computer and an internet connection could become a millionaire overnight. Startups eager to cash in on the frenzy were popping up everywhere. Every day, new companies were launched, each promising to revolutionize a different industry. Business plans were often hastily written, and sometimes little more than a vision of what could be. Yet, investors didn't seem to mind. The future, it seemed, belonged to the bold. One of the most hyped companies of this era was theglobe.com. Founded in 1994 by college students Stefan Paterno and Todd Kreiselman, theglobe.com was one of the first social networking sites. It allowed users to create personal profiles, share content, and interact with one another online. When theglobe.com went public in November 1998, its stock price skyrocketed, making instant millionaires of its founders. The company's initial public offering, IPO, became emblematic of the irrational exuberance that characterized the dot-com era. Another notable example was Boo.com, a fashion retail website founded in 1998. Boo.com aimed to offer a high-end online shopping experience, complete with advanced features like 3D product views and interactive customer service. Despite raising $135 million in venture capital, Boo.com struggled with technical issues and excessive spending. The company burned through its cash reserves quickly and ultimately went bankrupt in May 2000, just 18 months after launching.